The stock market, the S&P 500 seems pinned at that 5,700 level. We just can't seem to get above the Liberation Day high. We wicked above it today. This all comes on the heels of the most hawkish Fed speech that we've heard in a while. No rate cuts, no quantitative easing, foot on the gas pedal with quantitative tightening, citing mass uncertainty from the tariffs, stagflation fears, etc. And in other news, Google had a 7% day drop as well. Is it a buying opportunity? I think it is. We're going to get into that later. And today, as of the time of this recording, the White House just struck its first trade deal with the UK, although if you peel under the hood, it doesn't seem that shiny or that great. We'll jump into that as well. But if you care about your money, if you care about long-term investing, if you care about swing trading and trading in general, you definitely want to stick around towards the end of the video. I will show you an example of how I'm day trading these markets as well. Let's get right into it. So first we'll get into the news, then we'll get into the charts, then I'll show you an example of how I'm day trading these markets, and maybe give you some swing trading ideas to go as well based on where we are. So like I said, the Fed did not cut rates. That I think was expected. The policymakers voted unanimously to keep rates unchanged, meaning every single Fed member said no cuts. That sometimes happens, but is not always the case. And when you see a unanimous vote like that, then it shows that the Fed is actually putting its foot down here in the face of uncertainty with regards to the tariffs. Jerome Powell repeatedly said we don't need to be in a hurry. He also brushed off any political pressure from the president, which I think that back and forth has been there really even since the first Trump term. And for the first time throughout this whole ordeal, the Fed is stating that they are seeing stagflationary risks. Stagflation is when prices go up, but also the economy slows down. So how could this happen? If we are seeing a slowdown in inventory, if we're seeing empty shelves or less products on shelves, then obviously that can create a price spike because of the demand with limited supply. But if the economy is slowing down, that is really the double-edged sword or the worst case scenario that nobody wants to see is stagflation. Inflation with a growing economy still sucks, but at least the economy is growing as well. Like we saw, there's money printing on the table, right? There's liquidity injected into the economy. But when the economy slows and prices go up, that is the worst combination. So the Fed is saying that they're seeing stagflationary risks. And all of this obviously is because they do not know the extent of the tariff risk. Now, all that is fine and dandy, and I think that this back and forth between the Fed and the White House is somewhat expected, but we are now seeing the 2-year yield below the Fed funds rate. And this is typically when it gets too close or the Fed is too late to cut, right? You can see here every single time that the 2-year yield got below the Fed funds rate and the Fed didn't cut, the Fed is in red, the 2-year funds rate is in blue. You see that we get a recession before the Fed starts cutting, right? Same thing here, 2-year yield before the Fed funds rate. The Fed might do a cut, but then we are in a recession and then the Fed has to cut because we're in a recession. And we are seeing that very similar thing now. The 2-year yield is well below the Fed funds rate, and we will likely get a recession before the Fed actually slams the Fed funds rate and bringing yields down to the ground. Now, in terms of how the FOMC statement is going to affect the stock market, we typically see a delayed reaction. Even if we look in 2022, the day of the FOMC statement, we were up almost 2%. It was actually May 4th, if I remember correctly. Right here, we were up almost 3%. And then the next day, we dropped 3.5%. So this is why I tell people, guys, give the effects of the FOMC, give the market time to digest the effects of the FOMC meeting. And even though today, as of the time of this recording, we were green and we paired some of those gains, to me, this is not the market digesting FOMC yet. I think we will see it for days and weeks to come. Now, in terms of Trump's deal with the UK, obviously he was working it up, saying that it was one of the biggest, most historic deals ever. And when you look under the hood, the deal with the UK, although a good starting point and provided a little bit of optimism that, hey, maybe the worst of the tariffs are behind us, although more on that later, it was kind of really just a lukewarm deal. If you look under the hood, the U.S. runs a trade surplus with the U.K., meaning they buy more from us than we do from them, one of the few countries where that's the case. And we did not take the baseline 10% tariff off. So the baseline 10% tariff remains. A few non-trade barriers are lifted. They agreed to buy $10 billion of Boeing jets, and they said that they would increase beef purchases from the US as long as that beef doesn't include any hormones. To be honest, that's it. That's the deal. That was the entire deal. So with regards to the potential tariff risk, that 10% tariff still remains, and it's not seen as one of the countries that that would be a historic resolution if the tariff problem got solved, such as China, such as Canada, etc. All right, so that's the news. Let's talk about the charts real quick before we talk about trades. So where we are on the S&P 500 is exactly where we were when I made my last video. There have been a few important updates here, but this right here, again, I told you 5,700 is going to be a very stubborn level. The S&P tried to push past that and close past it today. We got to about 5,720. Back down, we are now at 56 and change. That 5,700 level is very stubborn for a few reasons. One, based on the Fibonacci ratios, this is the golden pocket of the Fibonacci. Two, April 2nd, this is the day that the tariffs were announced. This is Liberation Day, right? So all of the worry from the tariffs were erased because of the 90-day pause and, optimism surrounding deals. But this is, it seems, for now, where the market is okay trading at based on the information that we know. I also talked about there being a large options wall over here at 5,700. There's a lot of gamma exposure at 5,700. And if we take a look at the difference between ES and NQ, we still have that bearish divergence where NQ made a higher high and ES is making a lower high. This is on the futures. One more thing that I wanted to point out, if we pull up the moving averages, I want you to look at something. Let me remove this so it's not in your way, but look at this. We have the death cross between the 50 and the 200, the death cross between the 50 and the 300, and we are now retesting that 200-day moving average. If we go back to 2022, you can see that after the death cross formed between the 50 and the 200, every single time we hit the 200-day moving average, the green line, we drop back down. Now, you could say, hey, we were in a bear market in 2022. Here, not yet. We were still in a correction. We tanked 15%, had the death cross, retested the 200-day moving average before dropping further. And then at this point, we were in a bear market. And so these tests of the 200-day moving average were in a bear market context, but not this one. So in that sense, we are now doing a very similar thing here, and the 200-day moving average is around that 5,700 level. So yet another point of confluence and another reason to hedge here, whether you're selling calls, whether you're buying put spreads, whether you're buying puts for a certain portion of your portfolio, whether you're buying inverse ETFs like SQQQ or SPXS, right? As I said, I'm not a huge fan of naked shorting here, but I am a big fan of hedging here. Now, we could sweep liquidity above these highs just to fake the market out one more time before then retracing down. Now, as I said before, I don't think we get to that 4,800 without a recession or without there being material effects of the tariffs on the ground, meaning less products on shelves, price hikes, stagflation, etc. I don't think that we revisit the peak fear of the tariffs without there being a material visual effect of those tariffs. I don't think this back and forth, tariff on, tariff off, we made a deal, we didn't make a deal, I don't think that's going to take us to 4,800. This here was peak fear, right? So you have to understand how peak fear works. That is the maximum fear from the tariff on, tariff off rhetoric that now the market is tired of. So we actually need to see something material on the ground like, oh my God, this tariff thing is real. These prices are crazy, or these tariffs are real. We can't buy any July 4th products, or depending on when it comes around, Thanksgiving products or Christmas products or Halloween products or whatever, right? I don't think we revisit that unless that happens. But there are a couple of places that I'm eyeing here for a target. So one of them would be these equal lows here from April 30th. This right here on ES is at about 54.59. On the S&P 500, this would be around 54.30. On SPY, it would be around 541.50. So that's the first level that I'm eyeing if we do get a retrace. Second level that I'm eyeing is this gap here between April 22nd and April 23rd. So that would be around 529 to 533 on the SPY. If we're looking at SPX, that would be around 53.10 to 53.55 on SPX. So I don't think we're getting 4,800, but I could see I could see a retrace down to this level here, and then potentially this level here. Those are the two areas that I'm looking at. If we get to these levels on the S&P 500, I'm still a buyer of stocks. Depending on where the stocks that I like are when we get this pullback, I'm looking at a few stocks here. Obviously, the Mag 7, that's a known fact. But I'm also looking at, as I said, healthcare. It's almost getting to the level that I'm eyeing here at this trend line that's really been around for years. This trend line has been there since 2011. If XLV can get to this trend line at around in the mid 120s, then I will definitely be diversifying into healthcare as part of my portfolio. In terms of the Mag 7, Meta is a stock that I want to buy more of. I'm a buyer in this gap between 540 and 570. We saw about 37 million in Tesla calls, the 300 calls expiring June 6th come in today. I do think that we might see a run up before the robotaxi event, although we are stuck here in this range for almost 2 months. Me personally, I don't really want to jump on those calls just yet. I want to see a breakout and a retest of this box before jumping on any derivatives of Tesla in preparation for robotaxi. And then when the robotaxi event happens, I will likely sell into the event. I don't want to be a holder during the event. Now, in terms of Google, we had a 7% drop. And Google had a 7% drop because there was a report that came out from Apple saying that for the first time ever, they're seeing search volume on Safari drop. To me, this is a major overreaction for a few reasons. And we're still sitting on this trend line. This might be an opportunity to pick up some more Google here. One, we saw from their earnings that search revenue was actually up, not down. So it wasn't affected by this. Two, Android is the most used platform in the world. So if we're talking about mobile search volume, over 80% of the world's phones are Android, about half in the United States. Three, Apple Intelligence is already priced in. It's not out yet in terms of a full-fledged product, but we've known for a couple of years now that Apple's working on Apple Intelligence, and whatever they develop is going to replace on iPhones ChatGPT, Google Search, etc. So to me, it was not really that crazy of a story, especially seeing what we saw from Google's earnings and the fact that they're not guiding less in terms of search revenue or in terms of ad revenue. Also, remember, YouTube is the second largest search engine in the world. So, I don't know. I thought it was definitely an overreaction based on the numbers that we've seen from Google in their last earnings reports. I could contemplate buying calls here, to be honest, short-term calls for a move higher, but I don't know. I'm still thinking about that. If I do, I'll send it out in the Traveling Trader Trading and Investing Academy. I told you guys about ASML, massive push past 700 now. If we get a close above this fair value gap, this weekly fair value gap here, above 712, 713, if we get a weekly close above 713, then I think it's off to the races. And if we look at semiconductors, I think that they are prime for a pump here. If you look at this exact pattern that we saw back in 2022, look at this. Look how identical this is. And this exact pattern stopped at this trend line and also stopped at the golden pocket of the Fibonacci. Look at what we see here. This trend line, golden pocket of the Fibonacci as well. So I do think that semiconductors can see a big rally here after, if we do get a pullback, I think we can see a big rally thereafter. You could see here in 2022, we had a bounce off of that trend line and then a pullback before then rallying. So I can imagine something like that happening here barring obviously a recession or some of those recessionary factors that we talked about on the ground. Now, before I show you my live day trade, with regards to the hedge, when I will take the hedge off, is if this bearish divergence between NQ and ES does not remain, meaning if ES, the S&P 500 futures, if it takes that 57.75 level and this bearish divergence is no longer there, meaning we don't have a lower high on ES and a higher high on NQ, then I will likely take my hedge off for the time being, and will likely explore putting it back on if we take out that high on SPX from March 25th, right? Remember I said I could see a scenario, and we have seen times like this before, where we take out this high, faking people into thinking that we have a new breakout before then taking liquidity. If we take a look at 2022, you'll see something very similar. You can see this high here. We corrected and then rallied and took that high before then falling back down. So that's how I'm going to be managing my hedge here. If you want to trade live with me every day, link is in the description below. Come trade live with me at Market Open every day. If you want access to all of my swings and my long-term buys, there's many more than this. Link is also in the description below. Let me know what you think. Do you think that we're going to hit a recession? Do you think that the 4,800 lows without a recession are possible, or do you think we need a recession to get there? Do you think we are going to be seeing more and more empty shipping containers, or do you think deals will be struck before then? Do you think we're going to see less products on shelves? I want to know, I want to get a sense of how hyped, overhyped you think this is, or how real you think this is. Subscribe to the channel, enjoy the day trade. Stay safe out there, traders. Peace. All right, right now it is 8:56. We're in the 850 macro. So I took a short here on the indices. I'm going to explain the trade for you in a second, but basically overnight we had a rally, a counter rally after a very hawkish Fed. We had SMT divergence, bearish divergence between NQ and ES. We already swept London high. And this to me looks like the beginning of a market maker sell model here. I think we fade this entire move by tomorrow, which is Friday, right? And so right now I'm just taking a short off of OTE to get back down to London low here on NQ. At 1.5 hour, I'll move my stop to break even, which is around midnight here. But until we get there, I'm not moving it. I'm contemplating adding a contract here. If we get up to this BPR, I'll add a contract there. Let me check ES real quick. Yeah, we're still stubbornly stuck in this 5-minute fair value gap. That right there is exactly 2-to-1. I'm gonna go get some coffee. This better be at TP when I get back. I might take another contract here.
Order filled.
So we'll keep the this is how you add to your winners, right? So we'll keep the original stop for the one up there, and then we'll put the second stop here. But I want to take them down to that level. I want to take both of them down to this level here. So now we have two contracts here for a bigger gain. Market is opening soon, so I need to be very aware of any spikes here. But I like this position, guys. Let's see if we can get it. We add to our winners. We don't add to our losers. Go. If we put the nut there, that usually helps. Bam! Hit the nut, baby. 850 per account, guys. That's how you add to your winners. I only make a habit of adding to my winners. And I've done tons and tons of videos, short videos about this when I'm showcasing my trades. I wait for a quote unquote new trade setup. So if I enter a trade setup from the top and I'm shorting, once it creates, say, another imbalance, I treat that as if it's a new trade setup. Meaning if I was just entering the market and I saw that, I would enter from there as opposed to, you know, where I entered from initially. So I would take my second contract as a new position.